how to sell a covered call on Robinhood. That's a question that comes up quite a bit. So in this video, what I'm going to do is go over the step-by-step process of how you can sell covered calls in the Robinhood platform to make consistent passive income from shares that you already own, that you want to hang on to, and maybe sell at a profit, right? Because the covered call strategy is one of my favorites. It's great because there's no risk. You own the stock already, turn it into a cash flow machine. And this way, when you've got the shares that you already own and you're willing to let go of them at a profit, you can collect income. And if it doesn't, you get that income, you keep that premium, and you still own the shares. And if the price increases and you end up selling your shares at a profit, you keep the premium and you pocket your profit. So it's a great strategy. And in this video, I'm going to go over step-by-step how to do this. So just for fun, let's go ahead and I'll show you an example of how to do this on even Robinhood stock, right? We're in the Robinhood platform, so might as well do it on Robinhood stock. I don't own any Robinhood stock, so I'll buy some just for this video and I'll sell a covered call against it to show you the process, okay? So just make sure you are not copying this trade because I have not done any research. I'm literally buying this just to show you guys an example, okay? So Robinhood has a stock symbol hood. I'm going to click on that. Step one of selling a covered call is you need to own at least 100 shares. So let's go ahead and just buy 100 shares right now. Buy 100 shares, buy order. I'm going to do a limit order. The price right now is 63.67. All right, I'm going to do 100 shares. I'm going to go ahead and just buy right now. So, all right, let's do it. Place the order. I guess the stock went up a little bit, so it's not. Oh, there we go. It executed. Okay. Shares purchased 100. So now I own 100 shares of Robinhood, and now I can sell a covered call against this. So step one, you go into the Robinhood platform, you look up the stock that you own, and now you go into Trade Hood options. And the first thing you're going to do is select a strike price, and you're going to select the expiration. So let's do this step by step, right? So first, select the expiration date. For covered calls, I like to select an expiration date at least 30 to 45 days out because I want to hold on to that stock and there could be movements that could be happening. So, and I like to do monthlies because there's a lot more volume. So let's, for this example, let's go ahead and do 28 days out, which is June 20th, because the third Friday of each month are the monthly expiration dates. A lot of these will show you weeklies as well, but the third week of every month is the monthlies. So I'm going to go ahead and select June 20th, which is 28 days out. I'm going to click call, sell, and now I need to decide on a strike price. So since my cost was right around this price right here that we paid, right, for the 100 shares, you always want to pick a strike price that's at your cost or above. This way, you collect the premium and you also get appreciation on the stock itself. So for instance, if I bought it at 63 and some change, I'm okay letting go of it at $68, okay? This way, I pocket the difference, which would be that $5, roughly $5 difference in the 100 shares. So I'd make $500 that way if it was to get called away. And in the process, I collect $2.96 per share. So each contract handles 100 shares. So that's $296 in premium. So if Robinhood by June 20th, if it closes above $68, my 100 shares would get called away and I will pocket the profit and the premium. If Robinhood is below $68 at close on June 20th, I get to pocket this $296 and I get to keep my shares and I can repeat this process all over again. It's beautiful, right? So I'm getting paid literally to own my shares. So click, sell, $68. There we go, right? And right now I can collect $297 in premium. This is where a lot of people freak out. So let me tell you this. It's saying your loss is unlimited because that would be the case if I didn't have the 100 shares of Robinhood that I'm using as collateral for this trade. If I was selling a naked call, then yes, if Robinhood, skyrockets to say $200, I would lose a lot of money because that'd be 100 shares and the difference between the $200 and minus the $68 strike price, right? But because I own Robinhood shares and I own 100 shares of Robinhood right now, if the price was to skyrocket to $200, I'm obligated to sell at $68 those 100 shares. So this way, I would not take a max loss. And this is why the covered call strategy is so useful and so low risk because you win either way. If the stock stays flat, if it goes down, if it goes up, you still own the stock unless if it goes above the strike price that you selected. And at that point, it sells it. But because you were smart enough to select a strike price that was above your cost, that's why you profit no matter what. If you're planning on holding the stock anyway. And yeah, you could make an argument, well, what if it goes down? You are holding it anyway, not making any money. So guess what? When you sell a covered call, you're lowering your cost basis by that much because my cost, when I bought it, whatever price it was at, compared to when I sold this covered call, I just made income just for holding that stock because I wanted to hold it anyway. So don't go around telling me that, oh, what if it goes down? Well, you were going to hold it if it goes down anyway. So why not get paid for holding something that might go up, might go down, whatever it is? You like the company, you're going to hang on to it. Might as well turn it into an income generating machine for you. So I'm done with that little rant. So continue. Because I own 100 shares, I can sell one contract. And here's the difference. So the bid is $294. Ask is $300. I will try to get this filled at $296, just a little bit below the midpoint, right? Click review order and see, it tells you you're agreeing to sell 100 shares of Hood at $68 on or before June 20th. If you aren't asked to sell Hood by then, you'll keep your collateral and the full $296 credit. This doesn't include regulatory fees. So it's literally telling you what's going to happen depending on what happens with the stock price by that expiration date. Submit, filled. Perfect. I just collected $295. So now if I go back into Hood, if I go into the history, right, I paid this much for it today and, right, because that was my cost, filled and all of that stuff, 100 quantity, filled. And now here is what I collected. So I look into this, estimated credit. So I already got that credit. They put it in my Robinhood account right now for me to be able to use. Yeah, it's beautiful. I love selling cash secured puts to buy stocks cheap, and I love selling covered calls when I own the shares. And that is the initial basis of the wheel strategy. So now this is how the covered calls part work on Robinhood. If you guys want to check out the trades that I'm actually making, and these are just trades that I closed this week. Okay. All of my trades that I make, I share when I get in, when I get out. I send out alerts for my trades in my Patreon, and we have a great community chat where everyone's chatting it up with different ideas. I'm always in there answering questions. And I also have strategy guides, and I do my trade breakdowns whenever I do alert people on the trades that I'm making of why I'm making the trade that I'm making. So if you want to learn a little bit more about how to be more consistently profitable trading options, make sure you check out the link in my description below, and I will see you on the next one.